Hello, investors. This topic of diversification is very relevant in the current market scenario, wherein all your investment advisors are filling up their own pocket in the name of diversification of your asset base. As per me, diversification is only for those who doesn't know how to invest wisely or intelligently. In this topic, let me project the viewpoints of Mr. Warren Buffett, who has spoken much on this topic. So firstly, if you don't want to be a extraordinary investor but just a normal investor with ordinary nominal returns, then it is better to diversify just like an index fund. Index funds are like part of that country and betting on that theme. Say for India, investing in Nifty 50 is like betting on the index fund and participating in its gradual nominal growth year on year. Though extraordinary companies generate great profits, the laggards will diminish your overall returns in the index fund. Secondly, big opportunities has to be grabbed or encashed at that moment, and if you invest in small scale, it's a mistake and is equivalent to not investing at all. You really got to grab big and invest big for greater returns. For this, you need to really dig deep and know in and out of your investment idea so that you are sure of its expected future returns. As Warren once said, if you have got a punch card with only 20 punches and you won't get any new ones in your whole lifetime, you would think a lot before every investment decisions and you will make good ones and even bigger ones. Third point was Buffett's Berkshire Hathaway owns hundreds of investment now. It wasn't that way always. When Buffett was younger, he had fewer concentrated number of stock investments. To cite an example, when he was of age 21, he picked the stock Geico and had invested half of his net worth in that single stock. Now, to answer your probable doubt of why Berkshire has hundreds of stock investments, is because more the cash you hold, and that as you grow big, you will have to find more investments. Berkshire Hathaway is having around 4,000 billion dollar worth, which is actually a size of entire annual GDP of countries like Denmark, Ireland, and Colombia. Fourth point, as you all know, is Buffett considers stocks as pieces of business and its part ownership, and that we should concentrate on growth of that business by the profits and enormous free cash flow it generates going forward, and the stock goes up making us wealthy and not by the ticker price going up or down by some temporary bulk orders or trading. Fifth point is that Buffett views risk differently than most of other normal investors. Risk in an investment idea is considered by Buffett only if underlying business underperforms and not if there is a temporary stock ticker fluctuation. Sixth point is that Buffett invests in companies with high margin of safety, ensuring profitability even if the investment theme does not perform to the extent predicted. Margin of safety is explained in my earlier session number 3 of this value series. Seventh point is only invest in stocks within your circle of competence and with unique moat. Both these concepts are very well explained in my earlier session number 5 and 6 of this series. This hence increases the surety of good returns from the investments you choose. So to conclude, portfolio diversity reduction and to have more concentrated portfolio requires you to be a real insightful, intelligent, balanced, and a patient investor with complete knowledge of the investment you get into. My whole effort in this value series always has been to make you one such investor. And that you would be knowing that already since you are watching my 38th session of the series. Happy investing.